Hi, all. My name is Mike Rahm with Landmark Commercial Realty and Commonwealth Commercial Appraisal Group. As some of you might know, I love to write, been published in a few magazines recently, and am anticipating being published in a fourth national magazine on the topic that I'm going to be discussing today. The topic is psychology of real estate market cycles, and I think it's a very important thing that's going on right now. That you know, in the age of social media, in the age of um, just the mass media in general, we have quite a bit of people that are relying too much on these national trends as opposed to giving weight to the submarket, giving weight to what is actually going on in their neighborhood. So with that in mind, I wrote a few thoughts down and I wanted to simply just talk about them today and would love to get your feedback. So with that being said, we'll just get right into it. So implicit in the term cycle is that real estate markets are always in a state of flux. Real estate market cycles are specific to a submarket and property type. They're also specific to classification, A, B, C, or D, within a property type within a submarket. So in most cases, it's out of context to simply state that industrial pricing is increasing or office pricing is decreasing. Office demand could be increasing in a suburban submarket and decreasing in an urban market. Similarly, within a suburban submarket, Class A office may be in a completely different phase of the cycle relative to Class B. So we got to remember that national trends rarely perfectly reflect what's happening in a given submarket, nor do they account for the variability of consumer behavior. So it's important to be critical of the information we consume and apply to the markets that we serve. Why understand submarkets and property types? As commercial real estate agents, our job is primarily to advise clients and solve problems regarding buying, selling, or leasing property. We can be a valued member of a company's strategic operating process when we do a better job than they could do themselves in identifying trends and anticipating where pricing and market conditions will be in the next 6 to 12 months. This could influence a few things, right? It could influence timing of relocation or expansion of or departure from a market. So identifying a market's position in the cycle can also inform the length that a list price might be relevant, absorption rate for new or currently vacant supply. It could inform sources of future competition, what capitalization rate might apply to the current income, expected yield rates and a discounted cash flow analysis, and expected rent appreciation or decline expectations during a holding period. So now let's get to the power of the consumer mindset. There are many external influences on property value that include, but are not limited to, changes in interest rates, overbuilding or underbuilding in a certain submarket, changes in tax law, changes in construction costs, population shifts, job creation or loss in a local economy or regional economy, changes in affecting buying power, such as inflation, right? And what we're here to talk about today is market participant psychology, otherwise known as, consumer confidence. So market psychology arguably influences commercial pricing more than any other factor, essentially driving markets through the four phases of the cycle, which include recovery, expansion, hypersupply, and recession. Unlike investors in bonds and stocks, however, some commercial property owners prefer to force appreciation through their operating expertise. With this in mind, you can make an argument that market psychology influences these value add investors less because they're always in the market searching for deals. But very high level and generically, you're talking about human behavior, right? So ultimately, human behavior, consumer confidence plays a really big role in real estate. With that in mind, a buyer or seller's perception of the market, whether rational or irrational, will positively or negatively influence their decision-making calculus. Most influential, based on the way we now consume media, is that one's perception may be materially influenced by national trends, national media, that have little or no applicability to the participant's property type or submarket. There are two markets that influence real estate market cycles, and that is the physical market and the capital market. The physical market analysis answers the question, how much demand is there for space among users? Capital market analysis answers the question, how much demand is there for investment properties among investors? The capital market is influenced by changes in employment, population growth, and effective buying power. It's the interaction between users, i.e. demand for space, and developers or owners, i.e. supply for space, in an individual market. With exception to residential property types, the physical market is influenced on the demand side by demand among businesses. An individual business space requirement may or may not be consistent with the overall market trend for that property type in that submarket, though. For instance, office may be you see it a lot with office. Office may be overbuilt in a submarket in which multiple companies are breaking ground on an office development during a recessionary or recovery period, whereby building is not financially feasible just for sort of passive investment purposes. In other words, it's difficult to find a lot of demand out there to make spec building, for instance, financially feasible. The physical market for most commercial real estate asset classes is incredibly inefficient, as a lack of transactional data precludes our ability to discern the state of the market cycle in real time. This is also known as inefficient price discovery. So simply put, with commercial real estate properties, there's typically not an abundance of sales of a particular property type in a particular submarket during a short period of time to assert with a high degree of certainty where the property type is trending in pricing. So contrast that with market pricing in the residential market and the stock market. Both of these asset classes exemplify efficient price discovery, which is based on plentiful transactions and timely data. It's also important to note here that shifts in commercial real estate pricing generally occur over a long period of time, or longer than residential, for instance, as buyers and prospective tenants typically are accustomed to benchmark values or metrics in a given submarket. These benchmarks are reimagined over time, given outlier transactions, which are retroactively understood as the beginning of market shifts. Only in hindsight can we recognize these once outlier transactions were the start of a larger market trend. So for instance, there's a lot of tenants out there that are saying, I'm not going to pay more than $30 a square foot for medical office space. But if there is such a constraint on supply, there's going to be somebody out there that's going to end up paying $32 a square foot. An appraiser might say, it's not worth that. It's only worth $30 a square foot based on, these comps. But as more of those transactions occur, as long as supply continues to be constrained, then 32 becomes the norm and it becomes reimagined over time. That's sort of what we're getting at here. So we just covered the physical market. Let's talk about the capital market. In the capital markets, real estate investment competes with bonds, stocks, mutual funds, venture debt, hedge funds, among other vehicles. Real estate uniquely benefits, though, from depreciation write-off and is uniquely diversified in that the return of and return on capital can come from increasing net operating income, which is more of a supply-demand side argument on the physical side, or it can come from price appreciation, i.e. lower cost of capital, lower cap rates can push up value on the capital market side. So for these reasons, many investors aim to allocate a portion of their holdings in real estate. Now let's talk about the role of buyer confidence, which is sort of the whole point of this video. Ultimately, many commercial real estate transactions are prompted by one of three things: personal or collective investment criteria. I included collective because sometimes there's private equity, sometimes there's syndications where more than one person is actually bringing money to the table. 2, tax implications, and 3, individual space requirements. So any of these 3 factors can be incredibly specific to each buyer or seller making purchase or sale decisions. These individual transactions, though, we got to remember, are defined as investment value, which is a separate and distinct concept from market value, which is what appraisers, for instance, are tasked with analyzing in most circumstances. Market value, now this is sort of a hot take and a really loose definition, But market value is in practical application within the realm of commercial real estate can be loosely defined as a range of potential sale prices as evidenced by at least two similar transactions. The reason why I like to use two is because a lot of these transactions of commercial real estate that are similar in physical and economic character are few and far between, especially within a short period of time in a submarket. So there's just not a lot of people that are looking for a lot of the same type of space. Let's put it like that. Furthermore, the buyers and sellers of these transactions are typically motivated by completely different factors, which is why pricing for most commercial property types can widely vary. In this way, pricing is more of a reaction to consumer confidence or individual space or investment needs at a specific point in time, rather than robust market data in support of a list or sale price. It's really sort of like, pricing and demand is going like this in reality. It's changing like almost hourly in commercial real estate. But we don't really have enough transactional data out there to prove that it is. So it's all over the place a lot of times for most property types. Now, there are asset classes within commercial real estate that, 20-year net lease properties and whatnot probably don't fall underneath that category. They're probably not susceptible to dramatic changes on a, daily or monthly basis. But just understand that this is sort of what happens. So therefore, a more appropriate way to analyze most commercial real estate markets may be to characterize patterns as behavioral cycles rather than market cycles. Whether analyzing the physical or capital markets, it's important to remember that pricing for most commercial real estate assets is relatively inconsistent due to nuance of building characteristics and location, individual buyer or seller motivation, and lack of available information regarding supply and demand in real time. Therefore, consumer confidence is a factor to be considered. If enough people, for instance, believe that there's going to be a 20% increase or decline in values for a certain property type, whether rational or irrational, it's very likely that this trend will occur. And this is a concept known as groupthink. Real estate markets are driven by emotion and the fear of missing out. Therefore, in times when the economy is good, optimism will influence negotiations to result in higher sale prices. In poor or volatile economic times, pessimism will influence negotiations to result in lower sale prices. Now, here's the kicker, though, and this is sort of where we add value as agents. If fundamental analysis reveals that anticipated pricing expectations are irrational, real estate professionals can advise clients accordingly to capitalize on irrational market behavior. In the end, differences of opinion make the market, and perceived value is sometimes more important than the fundamental relationship between supply and demand. As real estate agents, we're trying to balance historical pricing trends with current consumer behavior, which is often unpredictable and is always uniquely motivated. Nevertheless, we still need to consider the whole picture, including consumer behavior, to provide more sound counsel to our clients, even in the face of the most chaotic markets. If you want to talk more about it, please contact me at mrom@landmarkcr.com, or you can call me on my cell, 717-215-9760. Looking forward to being a resource for you now and in the future. Talk soon.